This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. This is the Futures Hour, and on the second half of the show, right after the break, we're going to have Rich Anderson on from Anderson Capital Management. He's got some, I think, pretty important things to say, not just about commodities, but a couple other things that we talked about this morning, and he's going to share them with us. And then we're going to spend the most of the day, going over the commodity markets, as I see them. So that'll be a biased opinion, of course. But the first thing we wanted to look at, because we are looking at the broad commodities, I posted the ETF for the commodities into Tiger TV to start with, because we were looking at that a month ago when it was making the 61% retracement. And we've had this really strong rally, for about 10%, off of the bottom, which is, pretty much which has been happening with all the commodities. And, could this be the start of something big? We'll have to be able to, to wait and see. Before I start to the commodities, I wanted to talk a little bit about the cycle that we've been watching in the stock market, because, I was really focused on that January 23rd date, and it looked really good as of Wednesday morning until about 1 o'clock Eastern time when Bernanke came out, and then we had the rally that took it into new high. We went a little bit higher today. But frankly, we're at the same price at 13.18 as we were the other day at 13.17. So, I don't think this thing is, going to run away to the moon. But this cycle usually doesn't miss by 3 days, and that's what this is the, the third day past the day I'm looking at. So, to me, it's not working. But the only way that it would work is if we close down on the week. We would have to close, I believe, below 1311 in the S&P, to have a down week. And then I would say it was, the week of January 23rd that the cycle topped, and it was off one day more than I thought it could possibly happen. I will post the Bradley model that I'm looking at, because I'm watching the inverted model, and we're very, very close to Monday, which is the inversion Bradley date that we've been looking at. Originally, I thought the market would bottom into the 23rd and then have a pretty good rally, but we made a high into that new moon on the 23rd, and we've extended it another few days. So the lunar cycle is certainly not working, in my opinion. So the only other thing that we can look at is the Bradley model, and that should start down on Monday. Today's Thursday, so we only have a little bit of only a few more hours trading in the rest of the week. So we'll just have to wait and see. Now, what I did for the newsletter is I, wanted to enter on a sell stop, and those sell stops were not triggered because the market needed to get below 12,400 in the Dow in order to trigger those, and it did not do that. But as we get closer into Monday, I will probably, tighten it up and either go to the market or raise the sell stop, quite a bit. So that's how I'm playing it, because I think this is a real significant one. And but it hasn't triggered yet, so I'm just being patient to see. Everybody's incredibly bullish. What Bernanke did yesterday, basically talked about, easing money, which, everybody knows that he's easing money. That's not, anything that is new. We can see that in, what the interest rates are doing. What is amazing is the fact, that we had yesterday a $5,000 move in Treasury bonds. And believe me, the people that trade Treasury bonds are not the same people, that trade, the futures for the S&P and the Forex and stuff like that. Bond traders and bond holders do not like, wild volatility. So on a relative basis, it was a very, very wild day, in the Treasury bonds, at that particular time, and it's really quite amazing. Now what's really amazing is, the bond market, on a volume and open interest basis is about twice the size of the gold market, and about 7 or 8 times it's actually more closer to 10 times the size of the silver market. So, the bond market is a very, very active market. It, began trading as a future in 1976. And has become, one of the, the stronger ones. It's all electronic now in the Treasury bond market. So you basically have, a membership to trade the Treasury bonds. And one of the things, because, we have a lot of people that do trade commodities, I'm just going to show you, over the last 3 weeks, especially since the 23rd of January, you'll see in the Tiger TV, if you have a chance to take a look at it. All I did was show you the 618 retracements that have been occurring in the Treasury bond market. Yesterday, the market rallied from the low on the 23rd of January, which was the new moon, and it rallied up to the previous high at that 145 level, which was the 786 off the previous high, and it stopped within one tick, $31.25 on $100 and some $1,000 contract, and it stopped there, and then it broke down, went up 5 points, and then came down and it went up 3 points and came down 2 points in a matter of just a few hours, and it stopped exactly at the 61% retracement, on the downside to the exact tick. That was 141.23, and from that level over the next 24 hours, the market rallied up again to exactly the 61% retracement at 142.26. And then today's low was exactly the 61% retracement off of the 141.23 level. So if you get a chance to go into the Tiger TV and take a look at that, it's very very interesting. The reason why I bring this up is because this is what happened to silver on the daily basis. Several weeks ago, we were talking about this all the time, that all of the silver retracements were coming in at the 61% retracement. There were 4 of them on the way up before it finally, broke out to the upside. And we'll cover silver and gold before the show is over today. But mainly what I wanted to do was to show you that when you're trading some of these things and you're watching some of the patterns that we look at, if you'll watch these 618 and 786 retracements, they repeat over and over again, and it allows you to come in and give you a pretty good entry point. I know some of the folks that watch the Tiger TV use these types of numbers when they're trading, and they are very accurate. And the good part of it is that if you buy at the 618, you put your stop below the 786, and usually that's somewhere less than $500 when you're looking at these particular markets that you're watching. And the main thing that we're looking at on these bonds is we still think that we have a chance to make that 149, 150 level in the Treasury bonds. This would most probably be due to a stock market rolling over a little bit as a flight to quality, or some more problems with Greece or France or whatever countries the country of choice this year. Whenever they're beating somebody up, maybe it'll be the U.S. one of these days. But the original target that we're looking at still remains at 149. I want to be patient. I still think we've got a chance to make that. And if we go below 140 in the Treasury bonds, I'm going to have to reconsider that, because it looks like that we've made a distribution top, and the Treasury notes have actually made the target. But I still think the bonds have a chance to make it. I might seem like I'm rambling a little bit here, folks, because I get a lot of emails about this trade, because I've talked so much about getting short Treasury bonds. And I'm just trying to get the best possible, entry point that we can get. And we're over a real critical cycle this week. I still believe that January 23rd is going to look pretty good. I know the Fed has came in and shaken it up a little bit, and then also, the Apple earnings were really big, and Rich Anderson has some great information about Apple, and Rich not only follows the commodity markets, he also does quite a bit in securities. He used to be the broker's broker, for some of the very large traders and several market wizards who he's still in contact with all the time, and so he's on the inside of some of these things, and that's why he's good to have on the air. If you have questions for him, it'd be a good thing to ask, because he's on the inside on where some of these decisions come from, and it'll be fun to listen to what he has to say. Now, the first thing we want to talk about, I think, is because everybody has an interest in the silver and gold, that we should probably take a look at the gold market, because we're getting very, very close to the long-term retracement at the 786 level. But before I do that, I wanted to highlight what happened yesterday before I came on the air. This was very early in the morning in the Tiger TV. I posted the Gartley pattern that was forming in the gold at the 1650 level. This was over a 5-day period. The cycle had completed, and from that level it went $3 lower than the 786, and then rallied $80 an ounce. That's $8,000 in just a matter of a very, very short period of time. And since we're on gold, we have a question from someone about gold, and it's from Mark in Massachusetts. Are you there, Mark?
I am. How are you?
I'm very good, thank you. What can I do for you?
Well, I want to know about oil. Its cousin, refined gasoline. I heard several reports saying that we may be paying $5 a gallon for oil this summer, or $5 a gallon for gasoline this summer. And I wanted your opinion. What do you think of that?
Well, all I know is that we've had strong resistance in the oil at the 103 level. You know, we've looked at that several times over the past several weeks. We hit that 4 different times, and then we backed off to the $92 a barrel level, and then we came back and tested the 618 at the $98 a barrel level, and then yesterday, you know, we had a big move upward in the crude oil, and that was another one that we were watching yesterday because all of the commodities were making the same pattern. And if you get a chance later, Mark, if you'll go into Tiger TV, you'll see that the market from yesterday's low, which was the on the 25th, that, you know, we had made a almost a perfect double bottom, AB equals CD at that 97.80 a barrel, and at 98, that's the 61% retracement of the low from 3 weeks ago. So it had a 61% retracement, a potential, you know, double bottom there. And the market rallied, you know, a good $4 a barrel. But we really have to get above the 104 on a closing basis of the oil market in order to really get it moving. You know, I mentioned yesterday about people and opinions, and that includes me. Just because someone says that it's going to $5 a gallon, Mark, that doesn't necessarily mean that that's where it's going. Many people have hidden agendas. I hope you realize that.
I hear other people saying it's going to come back down, so I
Sure.
just wanted your one-man opinion. And one quick question on the stock market. When would you say that your indication has failed? Would you say that if we don't close at a certain point, I think you mentioned at the top of the show, that you would be looking tomorrow based upon a weekly chart?
Yeah, Mark, I've got to do a little commercial here for Tom. If you'll stay with me, I'll answer that question, okay? And I'll post a chart into Tiger TV so we can take a look at it.
Great, I'll hold.
Okay, thank you.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You've always taken the long view when it comes to investing. But what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while actually reducing your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns, making missed opportunities a thing of the past. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of The Money Game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back with Mark. Are you still there, Mark?
Yes, I am, Larry.
Okay, now, I don't know if you take my newsletter or not, but basically I talked about this on the show on both Monday and Wednesday, and that is the fact that we have, a spot with these AB equals CD patterns that I've been looking at. And even though with the Bernanke announcement yesterday we did make a slightly higher high, we have not violated those AB equals CD patterns by, not even by less than 1%. And so to me, those patterns are still good. The problem is that I really thought the 23rd was going to be the exact date. Now, we're out several days past that. And my history of the things that I look at, very, very seldom do you go out 4 days. I mean, usually when you're past 3 days, the cycle's not working anymore. And certainly the new moon cycle is not working because we've made a higher high than we did on the 23rd. That just means that there might be something bigger there. Now, the trigger that I'm looking for is that if the S&P closes below 1311 between now and Friday, especially Friday, if it closes below 1311 in the S&P on Friday, that tells me that you just circle that big date that we had on Wednesday when Bernanke was speaking. That will be the high of that particular cycle, and I think we're going to be down, for several weeks or even months if that in fact does occur. So that's what I'm waiting for. It hasn't happened yet, but this is how I'm looking at it. The financials have not performed well. They have made the ABCD pattern. The banking index has also made the AB equals CD pattern, and so many of these, and the volume has been horrible. So to me, this is not a breakout in stocks in any stretch of the imagination.
No, but some people think we may be going sideways too.
Well, I respect their opinion, however wrong it may be.
Larry, hey, you have a profitable day trading, and thanks again.
Okay, thank you for calling, Mark. I appreciate it.
Bye-bye now.
Okay, thank you. By the way, that was not my quote. That was a quote from Abraham Lincoln, one of my favorite quotes from one of my favorite presidents. Now we've got another favorite president on the line. We've got Rich Anderson from Anderson Capital Management. Rich, are you there?
Yeah, Larry, how you doing?
Take over the show, buddy. I need help.
All right. Well,
hey, tell the folks about the Apple, because I think that is the most interesting statistic that I've heard in a long time.
Yeah, this I'm a futures guy. I'm not a stock guy, but this just caught my attention when I heard it. That yesterday Apple traded $15.5 billion worth of stock, and the whole FTSE 100 only traded $5.5 billion worth of stock.
Wow.
We've been in the business a long time. When all of a sudden the volume gets real high and churny, and there's good news, who's left to buy?
Yeah, that's the question. But boy, Rich, let me give you a little advice. It's really tough to short Apple.
Well, I wouldn't short Apple, but I have the scars you always
to
want to sell the
weakest,
yeah. Not the strongest.
Sure, of course, and Yeah.
I don't know any stocks. I don't look at those, but I just thought that was an interesting statement. I mean, I talked to a friend of mine yesterday, and that he's always long Apple, but
yeah,
he got out. He got out. That I can understand it. Basically, Bernanke set the tone yesterday after the 2-day FOMC meeting. When he said that the Fed's going to keep the interest rate at zero till 2014. Well, all of a sudden, that makes things like gold, which doesn't gain any interest, it costs you interest. Excellent play, and then he gave the Bernanke put. He said that he was ready to offer additional stimulus if needed.
Mm-hmm.
He said that the 2% is what he thought the growth was, but there were significant downside risks. I mean, there wasn't anything friendly about his growth story, and it wasn't like he didn't talk about the idea that there are risks. And, there's still a big European debt situation that, near as I can tell, hasn't been resolved yet. So
I understand.
Mostly what Bernanke was doing was talk, not action. And, the risk-on trade, guys are coming back into some of the futures markets, although not all the futures markets are green today. But the markets these days, probably half of the market action is determined by money flow. When money's flowing in, it's like the tide; all the boats rise, and all the grain boats have risen. But part of that's a story about the basis. In the corn, it's been a vertical up market, but open interest's been down every day. It's been short covering.
Rich, stay with me.
The last item on option expiration is on Friday, and if I'm short. Okay. Let's say a 6:30 call goes through my strike price. I got to buy more. Say I'm short 1,000. I got to buy more.
Stay with me, Rich. Stay with me. We got to pay some bills. Stay with me. We'll be back in a minute. Okay? Hang on the line.
Hi, folks. This is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com, under newsletter, hit the Market Insight tab for your 2-week free test drive right here, right now.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes a carefully selected portfolio can lower your volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angelo O'Brien, financial advisor and certified financial planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, and we're talking with Rich Anderson of Anderson Capital Management. Rich, we were talking about the option expiration coming in this Friday, and then one other thing I wanted you to let our folks know about and talk about the basis of these commodities, because many folks that trade commodities don't understand the basis, and I think it's very important that they do.
Well, take corn. It's number 2, yellow corn. It's deliverable on the river up in Illinois. So, like in my farm in South Dakota, if we march corn today at 640, if I wanted to sell cash corn, I might get 30 under. I might get 610. Whereas if I've got a feedlot in Texas, and of course they had that big drought down there last year, and they don't grow a lot of corn anyway, they're paying up to $1 over for corn. And then of course so the difference between the futures price and the cash price is called the basis. So I would have a negative basis in South Dakota because I would get the price is less than the futures market. And down in Texas, if the price is a huge premium to the futures market. The export ports have all shown strong basis. They've all shown premiums that bases that aren't normally available except during the summertime. During the summer when you worry about the weather, that's when your cash basis normally gets the best, and last year it was a premium. And that shows real demand. But the export business is what's going to rule. Corn can only go up so much, and then it's going to be dragged down by wheat because down in Texas, they'll feed wheat rather than corn. And when they put cattle on a wheat ration, they're not going to flip back and forth. When they put a new pen of cattle in, they'll start them on wheat. They're not going to take a pen of cattle that they've been feeding corn and switch it to wheat. They would lose too much of their gain. It mess the animal
weight
up.
gain. Sure. Tell us a little bit more, because you and I, have been watching this very closely, about the MF Global and the fact that there's been RICO charges filed now against Corzine. I mean, it looks like the people that have money, still have money at MF, are not going to get it for several years if it's in the hands of the bankruptcy judge.
Right. Well, I read this story just like everybody else. The first thing I was shocked is that the Merck didn't step up to the plate and make whole the investors. I mean, that had been the expectation when Stotler went down many years ago. The investors didn't get hurt. People that had accounts at the firm didn't get hurt. They were reimbursed. Investors in Stotler got hurt, but it was a private company, and that's the way it should be for investors. But here you had apparently their broker that transferred their funds back and forth, or one of their brokers was J.P. Morgan, and apparently they slowed up the transfer of funds, which helped MF Global go down faster. And then once they went into bankruptcy, well, now you've got a bankruptcy judge appointing a trustee, and everything's run by that trustee, and it's going to take years before they get any more money. I mean, they still haven't figured out to, at least there's been no released reports to complete satisfaction of anybody where that money went and where it is now. I mean, was it all lost in the bond trades that he was doing?
Yeah.
But it's going to take years before they get any more money if it's ever found, and I doubt that it'll be found. So yeah,
okay.
Some laws had to be broken.
Okay. Listen, Rich, we'll have you on in another couple of weeks if that's okay. And
sure.
Where are you located these days? Are you in Naples? Or are you
I'm down in Naples, Florida. Beautiful, sunny Naples. It's absolutely gorgeous.
You've gotten a lot smarter in your old age, haven't you?
I know. I'm going to the beach for lunch.
All right, Rich. Listen, I'll talk to you later and give Lisa my best, and maybe we'll have you on in a few weeks, okay?
All right. Thanks.
All right. See you later. Bye-bye. Okay, we've got a call from Danny in Atlanta. I hope you held on, Danny. Are you still there?
I'm still here, Larry. Hi.
I'm good. What can I help you with, my friend?
Well, my question was, yesterday Bernanke said that the Fed was going to target a 2% inflation rate. To me, that seems like a stealth way of announcing unlimited quantitative easing.
You're probably right, but they massage those numbers to get the numbers that they want at 2%. If they don't like the fact that they took crude oil out of it years ago when crude oil was going crazy, and they'll massage that to get to the number. In other words, it's how they calculate the number. I've heard rumors that they're going to have the unemployment rate under 8% by the time the election comes up, just so that Obama can be reelected. And everybody knows that the number that's reported is very poor because so many people drop out of the rolls that quit looking for jobs. So these are things that I don't really care about, Danny. All I'm looking at is those charts, and I'm looking at that bar chart. And if prices are going up, I know they're buying. If prices are going down, they're selling. That's really all I'm looking at.
Okay, so when you look at gold now, I mean, are we going to get the retracement, or how are you playing it?
Well, I get that question 25 times a day. I've been waiting for retracement to 1570, and of course that's going to be a lot higher now. It's probably going to be closer to 1620. We had a good buying point, on the half-hour charts, yesterday at the 1652 level that I posted into the Tiger TV. But that was on a 30-minute chart, and most people don't have access to that. But this market's been up, I think 15 of the last 17 days, so it's certainly due for a correction, but we haven't had it yet, so I just have to wait. Sometimes you miss these. Now, people ask, am I going to miss the bond move? No, I will get into the bonds, but I have to wait to see what's going to happen after this cycle finishes this week. That's what I'm waiting to see what happens now.
Okay, great, thanks.
You bet, Danny. One other thing, what Danny was talking about was Bernanke. If they're going to get interest rates, low for 2014, that almost ensures inflation if the banks will come across and lend money. And that's the big question, is whether they'll do it or not. They can borrow money from the Fed at the window at a very, very cheap amount, and then they turn around, but will they, give it to the folks at a fair price? I mean, they certainly don't reduce the interest rates on the credit cards and things, but that's part of their huge profits, and so they're certainly not going to do that. Now, since we're in the commodities, I wanted to talk about the Baltic Dry Index. This is basically the dry bulk shipping rates. In other words, how much it costs, to rent a big shipping container from either Hong Kong or wherever you're sending it from. It's what these rates are, and we've had a tremendous drop in these rates since November, which means that the demand for these shipping containers is not nearly as strong as it should be if the economy is really turning. Now, there are several different ways of calculating this dry Baltic index, but I use a source from Bloomberg, which is usually pretty good, and I check it with others, and it's the same thing. These rates have been, dropping a great deal. Now, this is one of the things that happened in 2008, late 2007, early 2008, is that dry Baltic index had been going up like a rocket, almost like the price of Apple, and then all of a sudden, the rates just collapsed. And, we've had a collapse in rates here in just the matter of the dry Baltic rates. And since November the 11th, the rates have dropped, almost 50. In fact, they have dropped 50% in just that short period of time. Now, we've had a rally in commodities, and we've certainly had a rally in stocks, especially from that November 25th low. And so this really shouldn't be happening. This dry Baltic index should be turning up very, very shortly if the economy is going to be in really good shape. Now, the question is whether it's going to be in good shape or not, and I'm just looking at the prices of things, and I just know that we're at a critical level with all of these A, B equals CD patterns that we have, and none of them have been violated. They've gone a 0.25% or 0.5%. Some of them not reached the numbers like the financial index and the banking index. They have not made the actual number. They've missed it by a little bit. The NASDAQ has gone above it a little bit, but that's mainly due to Apple because it is a weighted stock, and it's one of the largest of all the weighted stocks in the whole thing. So that hasn't really changed very much. So these are some of the things that I'm considering when I'm looking at all of these different things, because it gives you an idea, of where we are as far as where the commerce is coming from. And the dry Baltic index, I've never traded it. All I do is I watch it. And the fact that it's had such a big drop, recently is, really quite amazing. Now we want to get back to the commodities a little bit here, because this is our commodity show, and I posted into the Tiger TV the fact that our silver chart has made the 786 retracement up at this 33.69 level. We went to 33.79. We're trading around 33.50 right now. So, but silver has actually been, leading gold for the first time, and gold and silver have been just one of the better investments for the first part of the year. I believe gold is up more than 8%, for the year, so it makes it one of the better investments, for the start of the year. Silver, I believe, is right there with it because it has been, moving a little bit faster than gold for the first time. And as we've mentioned several times on the show, the open interest and volume in these have actually started, to turn positive. We've got more players coming into the silver and gold as opposed to losing players, that we had since, last April. We've lost well over 40% of the people in the market, and so that we need to build this back up. But the good part about this is, if you're bullish silver and gold, is that we're at a relatively good level. Silver did get down to 26, and gold got down to the 1540 level. So they've had a pretty good rally from this level. They're very overbought now, and we want to watch a retracement, and if we're patient, we'll probably get one, and then that's what we want to be watching as far as if we do get this particular move in the gold market and silver market even more to the upside, which is certainly possible, because if Bernanke is going to put a unlimited money out there with the QE easing. And remember, I don't believe his QE2 worked either, but the question is whether the QE3 will work. I don't know. A lot of this will depend, on what happens with the with Europe and all this stuff, and that's where you start reading the news, you'll actually go bonkers. But that's neither six and one half dozen of the other. I want to focus here a little bit about crude oil, because the guy from Mark from Massachusetts asked about the oil market, and I wanted to post up the daily chart because it's very important to see where we are with the crude oil, because we have been up against this 103.60 level, which is the 707 retracement from the high that we made way back when the market was up around the 114 level, and that's what makes it really interesting, because if we can keep an eye on crude oil, because if it can close above the 104, that's going to be a pretty good breakout, I would believe, to the upside. And if that happens, then we'd be looking at this 117 to 120 per barrel level. But it has to get above that before it does it. And believe me, if we get to below 92, we'll be trading at 85 per barrel very, very quickly. So a lot of this depends on the price action over the next few weeks. But frankly, it looks a little bullish, because it took us a good 2 weeks to make a 61% retracement down around this 98 level, and then in a matter of just a couple of days, we rallied better than 5% to get back to above the $100 a barrel level. So that's what I'm looking at in crude oil, and it's holding up relatively well. I'm also keeping an eye on the natural gas, because that has made a 21-year low, and we've had a pretty good rally off of the bottom of that, and so I'm waiting for a smaller pattern to possibly enter by using one of the ETFs, because I know they have quite a few ETFs, at least 3 or 4, that work with natural gas, and we might be able to get in without risking very much. Natural gas as a futures environment is not very good for the beginning futures trader, because it's very wild and it can be a little bit too risky. But we do have the ETFs that give us a chance to look at these things, and that's what we'll keep an eye on. But these are longer term things that I have to keep in mind, to try to get us in, to where we really want to go. Frankly, the main things that I watch each day are the stock market, the oil market, the gold market, and of course the bond market. I'm always watching the bond market, because I really believe that's where that could be the one that, if you're right, you're going to be right on the money. I can remember back in 1983, the market had bottomed in 1981, and I was on the floor of the exchange trading Jenny Mays, and which was a mortgage-related thing, and these rates they're just incredible, and we were having a pullback, and the Jenny Mays missed the 61% retracement by about 4 ticks. And they hit that 4-tick level and immediately jumped about 2 full points, and they rallied forever, it seemed like. And so I'm watching this very closely, because of the long-term chart on these bonds. It looks very, very bearish, from making a topping formation. And I put it in here so many times people get tired of looking at it. Okay, we got to pay a few bills here. I want to get back, and I want to talk a little bit about soybeans, corn, and wheat, and also copper and the U.S. dollar.
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, just want to let you know I did give you some jewelry. My jeweler offered me about $650, but you get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, Oh, good.
And very happy.
Well, I appreciate it. Now, did you sell us jewelry or did you buy coins off us?
I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, folks, we're back, and we have a call from James in Denver. Are you there, James?
I'm here.
What can I do for you?
I just wondered, Larry, in regarding your T-bond scenario. You know, we've got a lot of money market funds out there that are invested in the Treasury bonds. And if your scenario comes true, I just wondered if maybe you think they'll break their $1 a share price.
Well, that's a possibility. You know, one of the functions of the market that Bernard Baruch used to talk about in his book, My Own Story, which was his autobiography, he said his opinion was that markets existed to make the average person make the largest mistake at the wrong possible time. That's what his feeling was about the market. So if this were the case and everybody, you know, had their money into these money market funds and, you know, they're only getting 2 and 3%, you know, they'll be getting a higher percentage, but the problem is the value of the bond will go down, so that would not be a good thing. So I think they have to be careful there.
Yeah. Well, that's what I was wondering about too. Your interest rates are going up, but the value of the bond is coming down. So, where are you?
Yes, that's what you have to be afraid of. And this has been going on for 30 years, James. This has been a long-term phenomenon. And as I mentioned in my show on Wednesday, I showed the relationship between 1941 and 1981, and then from 1981 to the next 30 years. And it's been a huge V from rates around 14%, almost to nothing, and now we're back to nothing again. So it's going to be really interesting no matter what. This pattern looks beautiful. I don't know if it's going to complete the way I want it to or not, but the market will give us plenty of chances to get in it because the Treasury bonds are so heavily traded and so many people are involved in it because it's much larger than the stock market itself. So that's a big thing we have to watch.
Yeah.
Just be patient.
I'm old enough, Larry, that I can remember those 14% interest rates.
Oh, I can too. I remember when I was at Drexel, I bought tax-free munis at 16%. They were called away after about 18 months, but boy, that was amazing at that time, to be able to do that. And I knew that it was, something life-changing was going on. And then when Volcker came in as Fed chairman, that really changed something. That's the one thing that Jimmy Carter did was to bring, Volcker in because, we had inflation at about 18% before they started massaging all the numbers, and now they take out food and other things, and so, this is what we're watching. What will happen on this particular leg, but my personal feeling is, and this is just, I think that eventually Bernanke's going to get his hand caught in a cookie jar or get burned on the stove or something and do something that's actually going to be hard to work out of, much like what happened with long-term capital. Long-term capital got caught on liquidity bind, and even though the Fed has never had that happen before, there might be something in the wind that would make him, look pretty bad history-wise. That's what history says should happen, based on the 1837 cycle that I looked at. But whether it'll be Bernanke or whoever, I don't really know.
Yeah, that's true.
I just hope it's not me.
Well, hopefully we'll have a new head come next year, and maybe that head will give us a new Bernanke too.
Well, we'll see. These are the political things that are really difficult to go through, but unfortunately we have to listen to them. Anyway, folks, we've come to the end of the day today, and I want to thank you all very much. Have a wonderful weekend. Watch the price of 1311 in the S&P futures. If we close below there on Friday, I believe that we've made a pretty significant top here because that would get us down on the week.